Good morning to those of you in the West, and good afternoon to those in the East. I'm Cynthia Kohler, Executive Director for Water Now Alliance, and we'll be getting going on our webinar in just a few minutes, so get your coffee and get yourself settled. We're going to give this about 3 to 4 minutes to let people sign on. Thanks. Hello, everyone. I'm Cynthia Kohler, Executive Director of Water Now Alliance, and welcome to the webinar. We're going to start in just a minute or two for those of you just joining, so get settled and we will get underway very shortly. Thanks for joining us. Good morning and good afternoon. Once again, I am Cynthia Kohler, Executive Director with Water Now Alliance. We're delighted that you are joining us for our webinar today on COVID-19 and the municipal bond market and implications for water utilities. Like so many of the sectors of our global economy right now, the COVID-19 crisis has raised concerns about the health and continued functioning of the municipal bond market. This is a major issue for cities, towns, and water utilities nationwide that rely on municipal bonds for infrastructure financing. As we reported last month, investors are continuing to see water infrastructure as a strong investment. In this webcast, we are very fortunate to have with us a terrific lineup of financial experts to help us answer the questions, what now with municipal bond financing, and whether and how can we use this challenging moment to move ahead with new innovations, or whether more conventional investments and financial strategies will prevail. So with that, I'm very pleased to introduce our panel. Moving to the next slide. Erin Boeke Burke is the Associate Director, Municipal and Cooperative Utilities with Standard & Poor's, one of the big 3 credit rating agencies. Tom Innis is the Managing Director with Piper Sandler Company, a multinational investment bank and financial services company. And Eric Letzinger is the founder and CEO of Quantified Ventures, an outcomes-based capital firm driving transformative social and environmental impact. So before we get going, we've designed this webinar to be as interactive as possible. So the panel will be providing brief presentations, and afterwards we'll shift to a more conversational format with questions from attendees. There are 2 ways that you can submit your question. The first option is by using the question and answer button here. Hopefully you can all see that. Our team will then read the questions out loud to the panelists, or we have an option for you to virtually raise your hand by clicking here, the second red arrow. And then that will allow you, we'll send you a message like this, and that will allow you to unmute yourself, and then you can say your question out loud. We just ask that you keep your questions as succinct as possible so that we have time to get to everyone. Then at the end of the webinar, we'll have a very brief evaluation survey for you. It'll be posted in the chat box, and there will also be a link to it when you leave the webinar. I'm going to thank you in advance for taking just a moment to provide us with your feedback. So for those of you who are unfamiliar with Water Now Alliance, we are a nonprofit network of local water decision makers advancing climate resilient, affordable, and environmentally sustainable water management strategies across the one water spectrum: drinking water, wastewater, stormwater. We focus on water leaders, mayors, city council members, supervisors in special districts, because they are responsible for upwards of 95% of spending nationwide on water infrastructure, and so quite literally hold the keys to the nation's water future. So sustainability, what does that mean? That's one of those terms that gets kicked around a lot. We define it as you see here: providing safe, healthy, and affordable water services for people while preserving the integrity of water resources and the environment for future generations. So how does that translate into our work? We engage in 3 interrelated buckets of work to support our members and advance those goals. We are a forum for engagement, connecting water leaders to ideas, resources, opportunities, innovators, and one another, as we are doing today with this webinar. We provide direct technical assistance to communities implementing projects on the ground, and we work on policy changes to clear barriers and open up new pathways for public utilities to grow their portfolio of water management options and enable them to better invest in innovative, sustainable, affordable, and climate resilience management strategies. We launched our Tap into Resilience initiative last year to elevate the potential of on-site localized water management strategies to address some of the nation's most pressing management challenges at the local level. Specifically, we've spent a lot of time working with financial institutions, like the folks that we have gathered together today, to expand the range of options for public water utility capital investment. So like many of you attending this webinar, we want to understand as much as possible about how this current crisis may be affecting the municipal bond market and what that does and may not mean for water utilities. So with that, I'm going to turn things over to our first panelist, Erin Boeke Burke with S&P, to provide an overview on the coming economic downturn and the impact on public water and sewer utility credit. Erin.
Thank you, and thanks again for having me. I'm really always so happy to have a chance to talk to folks, peel back the little bit on the black box that is credit ratings. So I'm going to start with doom and gloom, and then hopefully going to make it sound a little less frightening thereafter. To get things started, just talking about the credit conditions and what we're under right now. So S&P has in-house economists, and our April update was understandably dramatically different than what we had anticipated at the beginning of the year or even in March. As of April 16th, our US economist, given that 90% of the population was under stay-at-home guidelines, up from 3/5 just in late March, the economy has essentially stopped. We are saying as of that point that we are in a recession, and looking at what we're expecting, we're forecasting the US GDP is going to contract 5.3% for the whole of 2020. including a historic decline of almost 35% in the second quarter. So if you're looking at that chart on the left, the dark blue line, that was our baseline in December. The light blue line is our update from April 16th. So you see that 35% contraction in Q2. We're saying that the recession has likely reduced overall economic activity 11.8% from the peak to where we are currently expecting the bottom of the recession to be. This is approximately 3 times the decline that we saw during the Great Recession in 1/3 of the time. It's incredibly fast. In dollar terms, this is $566 billion smaller than where it was in just 2 quarters before the recovery begins. And obviously there's a lot of uncertainty about the recovery. We do expect it to be gradual as fears linger, social distancing endures, but we do expect the economy to at least begin reopening in the 3rd quarter. This is also a huge job story in terms of what we've seen. We're expecting headline unemployment to be as high as 19% in May, which is closer to Depression era's peak of 25% than the 10% high that we saw during the financial crisis. In contrast, unemployment was 4.4% in March. And this is the biggest jump in jobless claims on record, going back to 1948. We're expecting April will have been the worst, estimating 24 million jobs lost in April. All told, we're expecting from March to May that 30 million jobs will have been lost. And a lot of the change here is going to depend on how soon, once reopening starts, workers are able to be reunited with their jobs. Looking at the Bureau of Labor statistics, it does seem that a lot of the increase in unemployment was associated with people saying that they were temporarily unemployed as opposed to permanently. But another thing that we're keeping our eye on is how long businesses are able to survive under this environment and whether, when reopening occurs, those businesses will still be there in order to rehire their workers. According to a Chamber of Commerce and MetLife survey that happened during the pandemic, 24% of businesses said that they're 2 months or less from closing permanently, and 11% said they were 1 month away from permanently going out of business. So all of that, with all of that as the frightening backdrop, and also knowing that that's kind of the credit environment that we're in right now, as of April 1st, S&P Global put the sector outlook for all U.S. public finance sectors on negative. So what does that mean? What does a negative sector outlook mean? It doesn't mean that the outlook for every single rating that we have is negative. Instead, it means that we see this additional credit pressure. We're looking at the economic conditions, and we do expect more downgrades than upgrades for the remainder of the year. Where this also means other kinds of negative rating actions, negative outlooks, credit watches with negative implications. We're expecting a lot more of those. We do not see a lot of potential upside at this point in time. Nobody is going to come out of this recession stronger than they were going into it. And we do understand that a lot of these recession implications are not necessarily understood by issuers yet. They may or may not know what the implications are going to be for their financial performance, but we do expect that things will either be the same or less strong than they were at the beginning of the year, not stronger 2 months from now or 5 months from now. And it's also important to note that some sectors are going to be hit much more intensely and much more quickly than others. Some of the areas that we expect to be hit the hardest up front are local governments, especially where they have exposure to sales and tourism or lodging taxes, where where there may be a reduction in state aid due to revenue stress and financial stress at the state level. We're also looking at the pressure on healthcare providers and transportation credits, such as airports or transit. And looking at the CARES Act, I mean, the $2 trillion in economic rescue that has been enacted by Congress, it's gonna help. It reduces the risk of an even deeper recession. We think it's gonna help support the rebound in activity once we are able to actually open up again, once we get past the worst of this virus. We think it's definitely gonna help with the recovery, but it's not gonna be enough to offset the drag of the second quarter economic activity that we are anticipating. In terms of kind of across US public finance, the biggest pressures that we're looking at are pressures on liquidity, particularly. What's going to be happening with your cash? Do you still have access to short-term financing if you need it? We're going to be looking at high unemployment and what that means for budgets. Other declines in taxes, either due to less economic activity or other kinds of declines in revenues, which is more relevant to utilities, we'll get to in a second. And we're also looking at rising expenditures associated with COVID. So, too far. Sorry, there's a bit of a delay. Okay, there we go. So what does this mean for water and sewer utilities? Historically, S&P Global has viewed these utilities as very stable, and that is definitely reflected in the predominantly medium to high investment grade ratings that we have. The chart you see here, that's our ratings distribution from December 31st. So obviously it's a few months ago, but you can see that the vast majority of rated utilities are medium to high investment grade. That's A- or higher. That said, as the coronavirus contagion accelerates, as economic activity contracts due to illness, social distancing, we view these utilities as increasingly vulnerable. And our view means that we believe ratings on certain utilities are increasingly susceptible to the negative effects of the recession. It's very unlikely in the near term that we see upside potential for the current ratings, given this strong recessionary obstacles, particularly given the indefinite nature of the duration and the depth of the recession and of the pandemic itself. But like I said, certain utilities, not all utilities. So what are we going to be looking at most closely? We're going to be looking at utilities where there might be weakening sales, especially if they have a high commercial or industrial customer base. If the shuttering of those commercial establishments, of those industrial facilities, might remove a meaningful component of the sales, therefore potentially exposing utilities to lower cash flows, lower liquidity. That's definitely a trend that we're going to be looking for, or also where they might be more exposed to economic contraction, especially if there's a large travel or leisure or ethanol production component of the local economy and the customer base. We're looking at reduced capacity to adjust rates. We do think that there's a meaningful distinction between the legal right to adjust rates and the practicalities of doing so, particularly given the economic environment. We're going to be looking for rising bad debt expense. The additional affordability pressures with high unemployment, with low income level areas and customer bases, we're going to be seeing where affordability might be causing people to be delinquent or late on their bills, particularly since a lot of utilities have introduced shut-off moratoriums, or they're not assessing late fees right now. Essentially, which bills are going to get paid first? Is it going to be your water sewer bill, your electric bill, your cable bill, your phone bill? Where might the water sewer just have to sit there and wait a few months or potentially longer, and whether utilities will be able to get that money back in the long run, and if so, how much of it. And then we're looking at liquidity pressure, either due to a low cash position going into the crisis, weak performance in 2021 and 2020 that caught due to lower revenues or higher expenditures, or also the possibility that a local government that has intense short-term need of cash in order to be able to pay for ongoing city operations might either borrow or request an increased contribution from the utility, either on a temporary or a permanent basis. What does that mean for the utility's liquidity? And then also operational disruptions that could degrade service, or deferral of critical and non-discretionary maintenance or capital projects in order to help reduce expenses in the short term. What does that mean for the long-term operations and financial viability of the utility? One thing I really want to emphasize here is we're not focused on one-time events. Credit ratings are forward-looking. We know that utilities regularly experience year-over-year variance in their financial performance, particularly revenues, largely due to weather. And some of the variance we've seen so far has been weather-related, more so than COVID-related. But going forward, what we're going to be looking for is some kind of change in the new normal as far as the financial performance and the operational performance of the utility, and whether that new normal is weaker than the pre-recession creditworthiness of the utility. So we don't expect this to be a really rapid change. If we do see changes in credit throughout the sector, we do think it's probably likely to take place over a longer period of time. If revenue increases, rate increases aren't enacted for a couple of years, what then is happening to the utility's finances on a going forward basis? If there's a short-term draw on liquidity, is that being rebuilt or not? We're looking more at the long term and whether we think this is going to affect the future financial performance as opposed to just the next 6 months. And so on that basis, I think I'm going to take a break, pass off the mic, and then I'm happy to take questions.
Thanks so much, Erin. That was depressing but fascinating. And we're going to turn things over now to Tom.
Great. Let me see if hopefully I'm on. Okay, I got control. I don't see, oh, there we go, sorry. Getting ahead of myself, already screwing it up. I don't see the arrow to page back. Why is it going, oh, it's only going forward. I apologize. There we go, but I don't have the controls yet, I don't think. It's not popping up. Okay, I guess if I hit it. Anyway, sorry about that. Well, I am going to try to make it a little bit more cheery, and I appreciate being here, at least a little more cheery when it comes to borrowing rates. So for this part of the webinar, I'm going to put the rates in historical perspective, address current rates and other metrics that we use to help define the market, talk about the impact on water utilities accessing the market, and then provide an update on other funding sources. So I will try not to touch the slides as much as I can, but hopefully you're up looking at the historical market rate slide that captures rates going back 10 years for both the AAA MMD and U.S. Treasury rates. AAA MMD is the index we use to set tax-exempt rates for bond financings, and then U.S. Treasury rates are what we use for taxable financings. So you'll see volatility at the end of the graph representing current rates, but you'll also see that we're still at or about all-time lows over the past 10 years. So again, we're still in a good market. Apologize. Okay, that went backward again. There we go. So to see the direct impact on COVID-19, we expanded those same charts. You'll see beginning March 16th, when stay-at-home orders were put into place nationally, that rates spiked up significantly, basically shutting down the market for the last 2 weeks of March. You then do see a significant rally where investors enter back into the market Once they found their footing, there was a bump back up in rates. And since then, we've seen an oscillation of rates, but not as significant, clearly, as the end of March, with rates basically approaching where we began the year for AAA MMD, and then actually lower in U.S. Treasury rates, mainly due to Fed intervention. In terms of the other metrics we look at to see where the market is going, weekly fund flows indicate where investors are putting money into the municipal market, where those shaded areas are positive throughout most of 2019. In fact, all of 2019, that's where investors were putting money into the municipal market. You'll see the significant negative spike, again, impacted by COVID-19, where basically the entire investor market pulled out of munis. But the good news is since then, we've seen inflows, small outflows, but again, those oscillations are diminishing, and another sign that the market is stabilizing. We also look at 30-day visible supply, which is exactly what that says. It's what we think is going to be priced in the market for the next 30 days. Again, you'll see some certain volatility around the end of March, but it's stabilized out, and we're predicting or projecting over $10 billion of bond financings. Again, this is market-wide. I'll get into water on the next slide. Over the next 30 days, which is significantly above the $8 billion average over the past 2 years, and well above initial issuance in 2018. So again, both of these indexes we trace and indicate good, if not stabilizing signs that borrowing rates will stay low for the time being. Near and dear to everybody's heart here is water utilities and their ability to access the bond market. We show a graph of the past 7 weeks of specifically water utilities issued across the country. You'll see the impact, direct impact on COVID-19. It's beginning again on March 16th through the end of April. That being said, water utilities were the first to get back into the market. In fact, my firm did a refunding for the city of Lodi in California, water refunding, that actually achieved savings just below what we presented to their city council at the beginning of March, where we were experiencing all-time low rates in the muni market. The 3 weeks following the initial 4 weeks, or I should say the past 3 weeks from today, you'll see the significant increase in both par and number of issues, highlighted by north of $200 million issues for Great Lakes Water Authority out of Detroit and the city of San Diego water system. So again, signs that market is opening up, particularly when it comes to water utilities. Over these 7 weeks, 3.6 billion of water utility credits were issued in the market, of the 8.5 billion total 2020 year to date. So, but to put that in perspective, in 2019, over the same time period, only 7.3 billion of bond financings in the water utility space were issued. So despite COVID-19, water credits and water utilities have proven to be able to access the market, and at again, very attractive rates. In terms of other funding options, private placements certainly took the lead even when the public market was shut down, and still going strong. In fact, our firm just received a bid below 2% for a AA water credit that had a bond issue for 10-year final maturity. So those rates are still very attractive. State revolving funds, we're still waiting to see the impact of COVID-19. For those that work with state revolving funds, each state is different in terms of efficiencies and inefficiencies. Certainly, it's the lowest cost borrowing alternative in the market, but there are certain states where it takes as long as 2 years. That may be delayed even further with attention being paid to COVID-19 solutions. But again, there's not much definition regarding COVID-19 impact on state revolving funds. And same can be said for Water Infrastructure Financing and Innovation Act, or WIFIA, which was initiated in 2017. I have some reference slides following this slide that I'll just go over at a high level. But again, that could be more directly impacted based on other infrastructure acts that will be initiated by the impact of COVID-19. The next thing on the radar is what folks are calling CARES Act 2. There was a bond buyer article last week that indicated that act would reintroduce Build America bonds, private activity bonds, and tax-exempt advance refunding. So That'll open up the tool set even further for municipalities, for municipal issuance across the country, but in particular, water utilities who certainly took advantage of Build America bonds the last time they were put out in the market and during the last recession. As I mentioned, the next slides, WIFIA's round 1, 2, and 3. I capture the next 3 slides. Everybody likes maps, so we figured we'd include some maps here. That includes those issuers in white that applied for letters of interest, those in blue that were invited to apply, and those that originated as of the end of 2019. You'll see a pretty low percentage rate out of round 1 were invited to apply, but skipping ahead to round 3, if I can get there, much higher percentage as WIFIA became far more efficient. The WIFIA program became far more efficient, and also understanding the credit implications of those applying to intending to apply for WIFIA. In total, over the 3 years of the program, there's been 156 letters of interest, 99 issuers invited to apply across the country, but only 11 loans originated. So we certainly know it's a priority out of EPA to get loans originated. We can discuss it further if people are interested in the question and answer session. We do hope it opens up and becomes less restrictive to smaller, not only smaller issuers, but also smaller issuances and innovative issuances that Eric will just address in his next section. But with that, I will pass it along to Eric, and happy to answer any questions when we open it up. Thank you.
Thanks so much, Tom. Take us home, Eric. Tell us about innovation.
Thanks, Tom, and thanks, Cynthia and Erin. Pleasure to be here today. I think the arc of my message is a little rosier, a little more call to action, in the sense that under the umbrella of let's not let a good crisis go to waste, I think that the general temptation in a contraction or in a crisis is to throw innovation off the boat, and history tends to tell us that it favors the brave who don't throw innovation off the boat. At Quantified Ventures, we are an outcomes-based financing firm. We pioneered the model of the environmental impact bonds, which is merely a way for municipalities to attract impact capital to take some of the performance risk of innovative projects off of the government in a very low interest rate type of mechanism that reduces risks to the point where it makes it rational choices for municipal leaders to choose innovative resilience projects over business as usual projects. And I'll take you through a little bit of that history here, if I could function the slides. So this is no new news, but the challenges that you all face every day are massive and getting more massive and more complex. Budgets are strained. It's hard to find the nickels and dimes in the sofa to get done what you're expected to get done every day. That'll get harder. The good news is investors are motivated, and the investors that we draw on are impact investors who are looking to get their capital deployed to the type of innovative projects that are generally on the shelf and looking for ways to get on the field. Good news of that last slide is we do not have a capital constrained, the source of capital that we source for these outcomes-based financing transactions, they're highly motivated, and that source of capital is growing about 23% a year. Outcomes-based financing, what this is trying to do at its core is trying to, like I said, transfer some of the performance risk of innovative projects to this new class of investors who want to see more of these innovative projects put on the field. And by accessing this new source of capital, this is a source of capital that is tied to the intergenerational wealth transfer, meaning it's not going anywhere. This is a source of capital that wants to see innovation, resilience projects, adaptation projects, projects that are hard to get from idea to on the field, they're behind you. And these type of outcomes-based financing transactions tend to showcase cities who are raising their hands saying, yes, we're going to do something innovative. We're going to pay for things a little differently than how we used to. We're used to, I've spent a third of my career running agencies at the municipal government level. We pay for everything on the front end, and we got to pay back our bondholders regardless of whether the project worked or not. We're trying to undo a little bit of that and have some of these impact investors pay for the project on the upfront, relieving some of the risk for municipalities, and enabling you all to pay for the outcomes if they are generated on the back end, as opposed to paying for everything on the front end. One of the things that's unique about this model is that you've got to measure the outcomes. You have to predict the outcomes, and then you've got to measure them. And so as a result, the evaluation of whether municipal projects achieve their outcomes are a non-optional component of the financing. And as a result, municipalities who are using this model are building a library of evidence that drive better future decision making. Let's go through a couple of these examples, and then we'll shift to Q&A here. We did the first one of these in Washington, D.C. We called it an environmental impact bond. D.C. was faced with the classic conundrum of they had a combined sewer system. Shall we do the $1 billion gray infrastructure cistern, or should we do 350 acres of green infrastructure? The risk profile of those two options were quite different, with the green infrastructure being riskier and barely out of their reach, given the risk profile. Again, by bringing in impact capital to actually buy that environmental impact bond and take some of the risk of the green infrastructure, the risk meaning the performance risk of that green infrastructure, off of the DC Water and Sewer Authority's shoulders, it became a rational decision for the city to choose green infrastructure, i.e. innovation, over business as usual, i.e. the gray infrastructure cistern. That led to other cities wanting to take a swing at that model. Atlanta followed shortly with a $14 million environmental impact bond to finance a slew of green infrastructure across 14 neighborhoods, vulnerable communities that were dealing with a lot of ongoing flooding. And by putting this, the exciting thing about this particular transaction was it was the first publicly offered impact bond on the planet. So with each one of these, you'll hear a story of them getting better and cheaper and faster. And as this innovative model starts to get rolled out around the country. The city of Hampton, with their environmental impact bond, obviously this is a coastal location with low elevation. They are fighting for their lives, and they are issuing an environmental impact bond to finance the development of a handful of large-scale green infrastructure projects to address their flooding and stormwater challenges that they wrestle with every day. Buffalo, similarly, I wanted to put as many of these examples. You will all have access to these slides. I just wanted the participants to have access to these case studies. Buffalo, similarly, using this $30 million environmental impact bond to capitalize on an incentive program for green infrastructure that they have that incentivize their citizens to install green infrastructure on private property. That's the innovation here with this particular environmental impact bond. This next one in New Orleans is exciting. We are working with the Finance Authority of New Orleans, who are to bake in the concept of outcomes-based financing into a secondary mortgage green infrastructure product to incentivize citizens, private landowners, to build resilience practices on their properties. Here we've got an example of using this outcomes-based financing model as a way to reduce wildfires in southeastern Colorado. The thing I want to highlight here is multiple stakeholders, meaning you've got a whole bunch of cities and towns No one's got the resources to solve the problem. By flipping them to back-end payers, bring in private capital to actually pay for the interventions necessary to reduce the wildfire risk, then you're enabling governments to pay for the outcome in this case being reduced wildfires. Cynthia, how about I turn it over back to you and we can proceed with the Q&A portion.
Great. Thank you, Eric. I'm going to ask everybody to come on back and be part of the video so that we can have this, turn this into more of a conversation. And thanks so much to Eric and Tom and Erin. That was bracing and fascinating. We're going to take just a quick minute and review the tech again so that everybody attending has the opportunity to ask questions. As I indicated earlier, you have two options for asking questions. The first is to go to the Q&A button here, and I'll read out your questions to the panelists. Or if you want to participate more directly, you can virtually raise your hand by clicking here. And when it's your turn to speak, we'll send you a message. It will look like this. Are we catching up with this? And that will allow you to unmute yourself and speak your question out loud. So again, thank you for keeping your questions succinct so we have time to get to everyone. We have just a few questions to get the panel going. So to sum up what I think we've heard so far, the economy is in fact in very troubling shape, and this is likely to affect credit worthiness for at least some, maybe many water agencies. But I'm hearing also some good news that we are seeing that utilities are still being able to access the municipal bond market, and investors are motivated to get their capital deployed, particularly with regard to innovation. In other words, capital, their capital is not necessarily constrained. So I want to start with a question for you, Erin. You indicated that S&P will be looking for a change in the new normal, I think is the way you said it, of utility operational performance, particularly in light of the severity of the economic downturn. So can you unpack that a little bit for us? What kind of change do you anticipate looking for? What changes would positively influence utility creditworthiness? For example, would change in rate structures be part of that new normal so that they were less reliant on volumetric sales, or turning to the kind of outcomes-based approach that Eric was just discussing?
Okay, sure. I think in terms of looking at what that new normal entails, really what we're going to be looking at is proactive planning on the part of the utility and making really deliberate choices, even in a time when there's a lot of competing priorities and potentially a lot of political pressure, either to race through things, to do things business as usual, or just to freeze everything and wait for 18 months until everything calms down. 18 months is not an official projection from S&P. I do want to say that in terms of things that we're going to find concerning, it's going to be where there's a long-term reduction in the revenues that are needed in order to meet debt service, to pay for capital, and to pay for ongoing operating expenses. Any kind of permanent change in the finances, most likely probably because of choosing to defer rate increases for a year, 2 years, 3 years, while the economy is still recovering and while people are still hurting. In terms of things that utilities can be doing to position themselves well coming out of this, it's going to be looking at the capital needs, figuring out how can we potentially adjust our approach, what are the most important investments that we need to be making to maintain long-term compliance, environmental quality, maintaining strong relationships with your customers. I think rate structures are really tricky, and obviously each individual utility has their own needs and priorities with rate structures, like they do with everything else in running the utility. But I do think that revenue stability is an admirable goal, and it is something that we appreciate. That said, for some utilities, having a really strong metric or a really strong signal, hey, you're using a lot of water, this is actually a lot of work for us, and charging accordingly for that is also something that is another way to be more financially sound. But I think it's really, having a good explanation of how you're making those decisions, what priorities you have and why, and how this means that your utility is going to be the strongest it can be in terms of its operations, in terms of its public relations, in terms of its finances, is a way to definitely impress your ratings analyst.
Got it. So here's a question I'll just throw out for all of you. I'm starting with Eric's very appropriate tenet about never letting a good crisis go to waste. Water Now and a number of our colleagues have been making the case that on-site, localized, decentralized solutions have very significant potential to address the water supply, water quality, and stormwater management challenges we're facing, while also providing large local benefits in terms of jobs, greening, cooling neighborhoods, extending the life of great infrastructure. So my question is, does this moment present an opportunity for utilities to scale up their spending on these innovations along the line that Eric was describing? Is this the time for a large reset, taking the moment to shift and reprioritize? Or do you see ratings agencies and markets more likely to reward more of a business as usual approach? Maybe I'll put you on the spot, Tom, and then we can shift to Eric.
Sure. Coming from my background, I think in the short term, it may be more business as usual getting out of the gates, particularly if they introduce Build America bonds. You're going to see what happened in 2008 through 2010. You're going to see the big water systems with, north of $500 million financings. And I think that's the market's going to want to push through the gates first. I do think at the same time, investors are going to want a little bit more yield in their investments. As I touched on, despite all this, borrowing rates are still at an all-time low. Investors tried to spike it up a bit when they got back into the market, but there's a two-tier investor scheme right now, and I think they would appreciate innovations that might be slightly higher, smaller project costs, distributive system projects, but they can get a little more yield on those types of investments, particularly in the absolute low rates. But I do think in the short term, business as usual will be rewarded to help develop the municipal market going forward.
What do you think, Eric?
Well, I wouldn't disagree on the timing of that. And I think that Build America bonds infusion does give that federal subsidy that I think will help things in the short term. But in terms of, is the time right to be putting more of these green infrastructure or upstream solutions or distributed infrastructure solutions on the field? I think the overwhelming answer is now is the time. Why? Because we know that the business as usual solutions, we've paved everything. We've done, and by the way, we know we can't afford, they're expensive. They're expensive to maintain. We already know that. So defining the safe solution as more business as usual, when we already know we can't afford that, I think that math has been done. In which case, the safer option is actually to innovate in terms of putting more resilience-oriented projects on the field during this time. Now, it'll be really interesting to see how we enable cities to do that, because that's not easy. Business as usual is what we do every day, right? And doing it just one more day is not as hard as doing something very different. And we're going to need to see more than just Build America bonds that come to municipalities. We're going to need to see some real stimulus to come to municipalities that's soft, that's not just demanding shovel ready on day one, but it's giving some pre-development funding for municipalities to actually play some jazz as opposed to just play the scales over and over again.
So building on that, we have a question from our attendees. If or when the next relief bill includes billions of dollars for state and local governments, how will that affect the municipal bond market in your views? Who wants to jump in?
I can jump in. I can jump in again because it'll impact my side of it directly. And then the same thing will happen, which would happen in the last recession in 2008, particularly if BABs are introduced or reintroduced. I think it's going to continue to drive down rates. I do think it depends on the form with which they interject. If they put money into SRF programs, I'm not sure that's the best use, depending on the SRF program, state to state, because they just don't have the capacity to process those loans, even if they dumped money into those programs. I do think there's an opportunity, and having been at EPA and with you, or been in the room, I should say, WIFIA is certainly motivated by this current administration to get money out the door. They've been limited by the high entry fee of, at a minimum 100,000. So it's keeping the smaller innovative financings. It emphasizes on shovel-ready projects. I think if it opened it up to pre-development funding, then you have almost a two-tier WIFIA approach. And I think if that alternative is out there, then, back to the original question, I kind of went off the impact of the muni bond market. I think it's going to create more competition in the muni bond market, and drive rates down even further. Getting back to investors are going to have to figure out what to invest in. So circling back to innovative financing solutions there where they can get more yield, I think they'll tend to pull away from the business as usual, larger, vanilla bond financings as more funds come in and there's more alternatives created for the smaller financings.
So another question that's come in along the same lines, if you could advise Congress, if you were just, sitting there and they were doing whatever you said, on how best to support water utilities, cities, towns, special district, whatever size, what would you say? Where should the money go? The early money only went to 36 of the largest cities, and now they're considering, more broadly. So where should that money go? WIFIA, SRF, innovative green approaches, leveraging innovation in some way. The world is your oyster. What would you be advising the congressional folks who are thinking about this right now in light of your expertise? Any thoughts from you, Eric?
I'd like to see a portion of that funding coming from the federal government be in the form of back-end outcomes payments, meaning let the federal government define, this is the outcome we want with these funds. This is the price per outcome. Let the municipalities access this growing source of impact capital to get these type of resilience projects on the field that create those outcomes, and have the federal government with that pool of stimulus that's held back for success payments when outcomes are delivered. That seems the way to align interests from municipalities through the state up through the federal government.
Got it. So I think this is a question for a few of you. This is from our friends at UNC. It's likely that many utilities will have to use some of their reserves to cover revenue losses this year. I sit on a utility board. We're already talking about that. That's exactly right. Will that necessarily raise flags about potentially downgrading those utilities' ratings? Or will there be a temporary reprieve for declining reserves for a period of time until utilities recover? So maybe Erin, that's you.
Happy to take this one. I saw it pop up. I would say it's really going to depend on the size, the scope, and the duration. Are you talking about going down from 180 days to 150 days cash on hand? And do you expect to have that recover next year? Or are you talking about going from, 50 days cash on hand to 25 days cash on hand, and it might not recover for 2 or 3 years? Obviously, every credit rating decision is made by a committee. But like I said, we're really forward-looking in terms of our ratings. We understand that year to year things are going to change. We understand things are likely to change more than usual in the next year or two. So I think it's really going to depend on how much cash are you using, what's the plan to rebuild cash if there is one, and is this something that is going to be just the new baseline or not? And I would say it's really going to depend on the story that we hear about that.
So related to that, we have another question for you, Erin. Has S&P changed their metrics on days of cash versus financial rating at this time?
No, our criteria is the same. There's been no change to our criteria. And I just want to point out that in terms of how we look at liquidity, we look at 2 different metrics. One is your days cash. The other one is the absolute dollars of cash that you have on hand. We recognize that obviously if you only have about $3.2 million, which for some utilities is just mountains and mountains of cash, that still does not have the same ability to absorb as if you have 200 million in your reserves. So we're looking at the days, we're looking at the dollars, we're looking at whether that tends to come in once a year or if you bill only 6 months versus whether you bill on a monthly basis. We're also looking at whether you're a pipes only utility, or whether you're also doing your own treatment. So these are all the different kinds of considerations that we'll have when we're looking at liquidity.
Got it. So I've got a couple of questions for Eric, but I'm just going to go with one because we have a bunch of questions here, Eric. And maybe we can connect you up with this particular questioner who's got a long list of questions about EIBs. But the initial one is, what's the downside of EIBs if outcomes are not achieved? What happens at that point?
Well, what we like about the environmental impact bond is it aligns everybody's incentives, meaning if the project underperforms, obviously that's a bummer for the city. But with environmental impact bonds, that's also a bummer for the investor. The investor makes less or loses some. If it wildly outperforms, let's just take the DC Water Environmental Impact Bond. If it wildly outperforms, then that means they save $175 million and they share a few $1 million of that with the investors. So when the investor wins, the city wins. When the investor loses, the city loses. And if it works out just as we predict it will, then it's roughly the same interest rate as a standard municipal bond.
Great. So shifting gears, here's a question for everybody. If municipal sewage effluent monitoring for coronavirus turns out to be a surrogate or an alternative to mass population testing or tracing, I'm not sure about that, but if it does, how could that affect the water utilities market? And would something like coronavirus monitoring of sewage effluent qualify as an impact bond type of project? Everybody's thinking.
It's certainly an interesting question. I can't say whether it would qualify as an impact bond. I haven't even thought of that as an alternative, but that would carve another aspect out. I saw that question as it popped up, and it's intriguing, but it would certainly fit well within the water utilities market and something that would be marketable. I just don't know at this point whether it could qualify, having just first thought about it. Okay.
And I think that Lindsay on my team has somebody who has raised their hand and is going to be asking a question out loud. This is our one of our first experiments with this. So let's see how it goes. We're hearing from Courtney Knight. Do I need to do the unmuting or does he need to unmute?
Yes, my question was, given the prohibition on advance refundings that came into effect a couple of years ago, what are you seeing as ways to capture savings that historically were done through advance refundings? What are you seeing as ways to capture savings going forward with that prohibition in place?
Hate to keep taking over the questions, but I guess this is more in my world. Taxable advance refundings have been able to still be in place, and with taxable rates being as low as they are up through I would say March, there have been a significant number of taxable advance refundings. You couldn't do tax exempt, but you certainly could do taxable, and we never envisioned where taxable advance refundings would work even out to 2025, and certainly before the COVID-19. There were a lot of issues getting done in the market. We're currently hired on a big issue for the state of California, taxable advance refunding, and the rates are actually back to where they were pre-COVID-19, the borrowing rates, because of, I mentioned Fed interaction and borrowing rates being low. The only problem is investment rates are killing the escrow. We hope that recovers, so those refundings have gone off the table, but the alternative has been taxable advance refundings. They've worked quite well up until this point, up until investment rates have dropped significantly. But like I said, just through chatter, I think there's a high likelihood that tax exempt advance refundings will come back into play because they realize that probably wasn't the smartest decision when they pulled those off the table.
Okay, so we are just about up the hour. So anybody who wants to hang around, I think we're going to ask one last question and then we have just a couple more minutes. But this was an interesting question, so we want to be sure to get it into the panelists. With restrictions on shutoffs, collections, loss of late fee revenues, and people getting sick and even tragically dying from the pandemic, elected and even appointed board members passing rate increases necessary to meet existing bond covenants may become politically challenging. I would say that is the most polite possible way to put it. Setting aside debt service capacity, how will the industry and the market react if there's a rash of bond covenant defaults? Is there anything being discussed at the federal level to insulate the market from this potential risk? And how might it affect future issues? I'm sure you can all answer this in the 1 minute we have left.
I'll start, I suppose.
No, it's fine.
So I think, first of all, I just want to point out that most of the utilities that we rate operate well above their bond covenant levels. And while we do expect also that getting rate increases for the next couple of years might be incredibly politically untenable, we're not expecting that in many instances. It will be getting down to the level of choosing whether or not to break your bond covenants. That said, also a lot of times, even if you miss your rate covenant for a single year, there's some kind of mechanism to make that up. Sorry, my cat jumped into my lap. Before it's actually a violation of your legal provisions. Now, if there isn't the political will to stay in compliance with legal provisions, then we could see significant downgrades. But I would say right now, we still consider the likelihood of that pretty remote. And it's not something that would happen all at once. It was something that would happen and that we would likely see coming many months, possibly at least a year in advance.
Yeah, I would agree. I think most boards, elected or appointed, are going to really move heaven and earth to avoid those defaults, which would have their own political price. Okay, so I think we're going to go back to our slides very quickly. We want to let you all know that as a continuation of today's conversation, Water Now will be holding an Ask Standard & Poor's 2-day online event where participants can pose their questions to Erin about a variety of topics, including COVID-19 impacts on the municipal bond market, what those changes mean for utilities with existing debt and those considering issuing new bonds, and S&P's creditworthiness factors. Really, the sky's the limit. We'll be sending out registration information on that early next week. Space will be limited, so we encourage you to register early. Finally, we'd like to ask you to, for those of you who are not yet members of Water Now, we encourage you to join. Membership is free, and you will be part of a growing network of water decision makers advancing sustainable and innovative solutions like those you've been hearing about today, with access to a host of resources, experts, and opportunities. Please reach out to us if you have any questions, or just go to our website at www.waternow.org. And once again, we want to thank you in advance for completing our very brief evaluation. You can find the link in the chat box, or as we exit this from this webinar, you'll have an opportunity to be directed in that direction. We take your feedback very seriously. This is how we continue to improve our offerings. With that, I want to thank our panelists, Eric Letzinger, Tom Innis, Erin Boeke Burke. It's been a really exciting and interesting conversation, and we look forward to many more. Stay safe, everyone, and be well.
Thank you.
Thank you.